Hello and welcome to Eagle Investors Eagle Academy. Now, for this first unit within trading, we will be doing a brief introduction of the stock market. In this lesson, we will be providing you a basic understanding of what the stock market is. You will learn basic stock market terminology and what it truly means to buy a stock. You will also learn more about present value and why it is important to invest. Now let's get started. In terms of the stock market, what is the stock market? The stock market is a marketplace for buyers and sellers of shares of companies. Share represents ownership within a company. Companies issue shares to the public to help them raise money. Now, buyers and sellers have different prices for what they're willing to buy and sell for. We'll later get into what a bid-ask spread is, but there are brokerages that facilitate the transactions of buying and selling stocks overall. Now, something important to keep in mind is when you're actually buying a company, you have to see what their stock ticker is. For example, one of the most well-recognized names within investing is Apple. Their ticker is AAPL. Each publicly traded company is identified by a stock ticker that is between 1 to 4 letters. A lot of times these are abbreviations of companies used to identify the company on the stock market. Just like, for example, how there's an address to a specific building, this is a way to actually find a specific company. Now, one question I like to ask everyone is, would you rather have $1,000 today or $1,000 tomorrow? Now, a lot of people prefer to have money today, as over time, due to inflation, especially, the buying power of the dollar decreases. Now, something to keep in mind is when you're building wealth overall, you have to answer these two questions. Are you able to save each year? And when you save, where do you put your money? So depending on your risk and reward tolerance, which we'll get into a little bit later, you are able to decide particular investments that you're able to put your money into as well. Now, in terms of compound interest, this is a very important factor to keep in mind, especially when you're investing for the long term. Say you put $1,000 into the stock market every year for 50 years and assume an average return of 10%. You will eventually end up with almost $1 million and $360,000. So it's important to start saving money early. And also, if you're able to generate a higher rate of return, especially based on the risk that you're willing to take, then you could potentially end up with a large lump sum in the very end. So make sure to start early, and the higher amount of money you can save each month or each year, can truly lead to a much larger lump sum payment at the very end. Now, to conclude this lesson, the stock market allows for buyers and sellers to trade shares of companies. People invest to build wealth, and compound interest can not only magnify wealth, but it can also allow you to meet many of your goals, especially if, for example, you have a goal to potentially save up for a kid's college tuition or save up for retirement. Investing early while generating higher returns can generate into large nominal returns in total. So keep that in mind, and make sure, especially when you're trading, to fit your own picture, as everyone has many different types of investing goals and they're willing to take different risk and returns, which we'll talk about a little bit later in the future chapters.